Nearly £300 a winter is sitting in a government account with your name on it, and most pensioners never see a penny of it because of one simple misunderstanding about their own income. I'm Arthur, and I want to walk you through 3 surprises that could put real money back in your pocket this year. Not vague advice. Specific numbers, specific dates, and the exact mistakes that cost people money every winter. Here's the shape of it. The winter fuel payment is worth up to £300. The warm home discount is worth £150, and underneath both of those sits a third benefit, pension credit, that can unlock up to £14,289 a year in extra support once you qualify. Add it up, and you're looking at close to £14,739 in help that many pensioners are entitled to and simply never claim. That's not a typo. That's the actual scale of what's on the table, roughly the same size as a small car, or a decent chunk of a boiler replacement, sitting unclaimed because 3 separate rules each have a catch most people never hear about. The first surprise is the one that trips up nearly everyone. It's about a number, £35,000, and what it actually measures. Most people get this wrong, and getting it wrong costs them the full payment. If you're a UK pensioner, or you're getting close to retirement, and you want to make sure you're not leaving money like this on the table, hit subscribe now. I'll walk you through exactly how to claim what you're owed, one surprise at a time, starting with the one that catches out even careful, well-organized people. Let's start with that £35,000 figure, because it isn't what most people assume it is. The winter fuel payment is back for most pensioners this year. If you were born on or before the 27th of June, 1960, you could get between £100 and £300 toward your heating bill for winter to 2026 to 2027. Straightforward, until you hit the small print about who has to pay it back. HMRC claws back the entire payment once your individual taxable income passes £35,000 a year. Not household income, not your joint income with a partner. Your income alone from your state pension, any private pension, and anything you still earn part-time. Go £1 over that line, and the whole £300 gets taken back through your tax code, or through your self-assessment return, if you file one. Here's the part almost nobody mentions. That £35,000 line gets tested every single year, not once. Your income can sit safely under it this year and tip over it next year without you changing a single thing, just because your pension rose with inflation or you picked up a few extra shifts. 2 neighbours can live on the same street, both drawing a pension, and end up on opposite sides of that line simply because one of them still does a few hours of part-time work and the other doesn't. Take Susan. She's 67, retired, living alone in a home she owns outright. She gets the full new state pension, which works out to £241.30 a week, or around £12,548 a year. On top of that, she has a small private pension paying her £8,000 a year. Add those together, and Susan's individual taxable income comes to roughly £20,548. Comfortably under £35,000. She qualifies for the full payment without any trouble. But plenty of people in Susan's position assume the opposite. They hear £35,000 and they start adding up things that don't belong in that number. Their savings, their partner's pension, a lump sum sitting in the bank. None of that counts. The £35,000 test only looks at your own taxable income, the money HMRC actually taxes you on each year, not what you own and not what sits in a joint account with someone else's name on it, too. Picture a couple where one partner still has a modest workplace pension worth £30,000 a year and the other has just the state pension and nothing else. Looked at as a household, it might feel like they're comfortably off. But the rule doesn't look at the household. It looks at each of them separately, which means the partner on the state pension alone almost certainly qualifies, even while their other half gets clawed back. If you're one of the thousands who thought your income was too high because you were counting your savings or your spouse's pension, you're not alone in that. It's an easy mistake to make. But that mistake, on its own, could have cost you £300 you were entitled to. I used to think the same way. I used to assume household income was the measure until I helped my aunt fill in her own paperwork and saw, in black and white, that the official rule only looks at what's taxed in your name. That single misunderstanding would have cost her £300 for no reason other than reading the rule the way most people naturally read it. So the fix here is simple, and it takes about 5 minutes. Add up your own taxable income for the year, just yours, and check it against £35,000. If you're under it, the payment should reach you automatically once you hit the qualifying birth date. If you're close to the line, or just over it, that's worth knowing too, and we'll come back to what that means. But even if you sail comfortably under that £35,000 line, there's a second surprise waiting, and this one has nothing to do with the government. It's about your energy supplier and how fast their money runs out. Most guides describe the warm home discount the same way. They say you could get £150 off your electricity bill this winter. That's true, but it leaves out the one detail that actually matters, which is that the money isn't unlimited and it isn't waiting for you whenever you get around to applying. The warm home discount is a fixed pot of money, split between energy suppliers and handed out largely on a first-come, first-served basis. Once a supplier's share of that pot is used up for the year, it's gone, regardless of whether you were eligible. If you already receive the guarantee credit part of pension credit, you're usually in line for the £150 automatically, no separate application needed. But usually isn't always, and you still need to confirm it with your own supplier. Because letters go missing, records don't always match up, and mistakes happen on both sides. The discount applies to your electricity bill specifically, not your gas bill, which surprises people who assume it covers whichever fuel they use to heat their home. For winter 2026 to 2027, suppliers start sending out confirmation letters from around the 20th of October through to the end of December. If you haven't heard anything by early winter, that's your cue to call, not wait. I spoke to a viewer last year, a gentleman named Brian. He's 72, and he receives pension credit, so on paper he had every right to that £150. But he waited until December to call his supplier and check. By then, the fund for that year had already been allocated. He didn't lose the money because he wasn't entitled to it. He lost it because he called 5 or 6 weeks later than he needed to. That's the part that stings. This isn't a case of the system working against him. It's a case of a deadline nobody told him about clearly enough, and a phone call that came in just after the money had already gone. Every autumn now, I set a reminder on my phone for the 1st of October. It just says, call energy supplier, check warm home discount. I treat it the same way I'd treat a dentist appointment, something easy to put off and expensive to miss. So if you take one thing from this section, let it be this. Don't wait for a letter to confirm you. Call your supplier once October starts. Ask directly whether you're on the list for that winter's warm home discount and get a reference number or a name attached to that call. Keep the supplier's phone number for their energy team somewhere you'll actually find it again, not buried in a drawer with last year's paperwork. It costs you 10 minutes. Skipping it can cost you £150. But the third surprise is the real one, because this next benefit doesn't just hand you £150 or £300. It opens a door to thousands of pounds a year, and almost nobody realises the door is even there. Pension credit doesn't look like much on paper. For a single person, it tops your weekly income up to £238. For a couple, that figure is £363.25. If your income already sits close to that, the actual top-up might only be a few pounds a week. Here's why that small number matters so much more than it looks. Pension credit works as a gateway. The moment you qualify for even £1 of it, you're also entitled to council tax reduction, help with NHS costs, and if you're 75 or over, a free TV licence worth £180 a year. Add a warm home discount and the winter fuel payment on top, and the value of that single £1 qualification stretches into thousands. Take Susan again. Her state pension and her private pension add up to around £20,500 a year, plus £50,000 in savings she built up over her working life. Her instinct, like a lot of people's, is to assume she's too comfortable for anything with the word benefit attached to it. But pension credit is assessed weekly, and savings over £10,000 are converted into a smaller weekly income figure, not counted pound for pound. Once you run Susan's numbers properly, her weekly income lands under the £238 guarantee threshold, which means she qualifies for at least some pension credit, and that one qualification unlocks the entire gateway behind it. Here's the trade-off if you never check. Skip pension credit because you assume you won't qualify, and you also skip the council tax reduction that can run into hundreds or even close to £1,600 a year depending on where you live. You skip the free TV licence worth £180. Over a 20-year retirement, that's tens of thousands of pounds in support you were entitled to and never touched, not because you didn't qualify, but because you never checked. Here's the trade-off if you do check. Even a top-up of £5 or £20 a week is enough to trigger every other benefit behind it. That's the entire logic of a gateway benefit. The cash amount is almost beside the point, and it's easy to underrate a payment that small. It's the key that matters, not the coin. I'll be honest about something. The first time I helped my own mum apply for pension credit, I felt a knot in my stomach doing it. It felt like admitting she needed a handout after a lifetime of managing on her own. Then I stopped and did the maths on what she'd actually paid in. Decades of national insurance contributions on top of decades of tax. This isn't charity. It's money she's owed back, the same way a tax refund is money you're owed back, not a gift from anyone. The average pension credit award currently comes to around £4,300 a year. And when you add the passported benefits behind it, the full value of the gateway can reach up to £14,289 a year for some households. There are extra additions too, a carer edition worth £48 and 15 pence a week for anyone caring for another person, and a savings credit top-up for people who reached state pension age before the 6th of April 2016. Even if your own number lands well below that ceiling, checking costs you nothing, and not checking can cost you a great deal. So the knowledge is there now. 3 separate surprises, worth potentially thousands of pounds between them. But knowing the rule and actually acting on it are 2 different things, and there's a reason so many people who could claim this money simply don't. If you've gotten this far and you're still thinking, that's probably not for me, you're not being lazy. You're running into something much more human than that. A lot of people who spent their working life building something, paying into a pension, keeping their finances in order, feel a kind of resistance to the word benefit. It can feel like a step backward, like admitting the plan didn't quite work out. That feeling is completely normal, and it has nothing to do with whether you actually qualify. Opening an envelope from the DWP can bring up more discomfort than opening a bill for double the amount, simply because of what that envelope seems to say about you. There's a name for part of this. Some people call it the ostrich effect, avoiding a financial question altogether because looking at it head-on feels uncomfortable. Underneath that sits another instinct, a sense that claiming support somehow devalues the years you spent working and saving. Neither of those feelings is a character flaw. They're just common, and they're worth naming so they stop running the show quietly in the background, nudging you to close the tab instead of filling in the form. Try thinking about it differently. If HMRC overcharged you on tax, you'd claim the difference back without a second thought, and you wouldn't feel guilty about it. Pension credit works the same way. It's a return on decades of national insurance contributions, not a favour anyone is doing you. Ask yourself honestly, would you hesitate this much if the letter had come from your bank instead of the DWP? You are not a scrounger for claiming something you're legally entitled to. This system exists specifically for people who worked, who paid in, and who now deserve some stability without having to fight for it. That includes you, whether or not you feel like it applies to you. None of this requires you to feel differently before you act. You can still feel a bit uneasy about it and check your eligibility anyway. The feeling doesn't need to go first. Filling in a short form on an uncertain afternoon costs you nothing, whatever the answer turns out to be. Now you know the 3 surprises, and you know why your first instinct might be to shrug and move on anyway. Here's exactly what to do about that over the next couple of days. Let's bring this together. 3 things worth checking, in order. First, work out your own individual taxable income, just yours, not your household's, and check it against £35,000. If you're under that line and you were born on or before the 27th of June 1960, your winter fuel payment should reach you automatically for winter 2026 to 2027. Second, call your energy supplier once October starts. Don't wait for a letter. Ask directly whether you're confirmed for that year's warm home discount and get a name or reference number for the call. Third, check your eligibility for pension credit. Even if part of you assumes you won't qualify, even a small weekly top-up unlocks council tax reduction, help with NHS costs, and a free TV licence if you're 75 or over. Taken together, that's close to £14,739 a year some households are entitled to, sitting behind 3 checks that take less than an hour combined, spread across a phone call, a quick sum, and 1 online form. If this video helped you see something you'd been missing, subscribe to Arthur's UK Retirement Guide. I'm here every week, turning the pension system into plain English, so you don't leave money like this on the table again. And if there's a pensioner in your life, a neighbour, a parent, a friend, who might be missing out on any of this, send them the video. One conversation, or one share, could put thousands of pounds back into someone's year.